Hi there, Gigi from the RBA. This video is an introduction to monetary policy, which is probably the most well-known part of what we do here at the Reserve Bank of Australia. To get us started, what is monetary policy? Monetary policy describes a process that the central bank, which is the Reserve Bank in Australia, uses to influence interest rates in the economy. The central bank influences interest rates to achieve a set of objectives, which help it to meet its responsibilities, evaluate how good of a job it's doing, and inform its future decisions. This is a pretty broad definition, and it seems to raise as many questions as it answers. Some of those questions might be, why does monetary policy involve interest rates? What are the RBA's objectives? How does the RBA influence interest rates? How do changes in interest rates impact the economy? And how does the RBA measure whether it's meeting its objectives? So there's quite a few questions here, and this means that monetary policy is a big topic. Over the course of a few videos, we'll answer each of these questions in turn. So our first big question that we'll answer in this video is, why does monetary policy involve interest rates? To explore this, let's think about money in terms of one of the first things that you learn in economics, opportunity cost. Now remember, opportunity cost measures the next best thing that you give up by making a choice to do something. So imagine that you have some money. Now you could use that money for something. You could say spend it in any number of ways. But remembering the idea of opportunity cost, what is the next best option that you give up by spending the money today? Well, if you didn't want to use the money today, you could put it somewhere safe to use tomorrow. Where would you put it? Well, the bank seems like a good option, and if you put it in the bank, you would earn some interest, which is measured as an interest rate. And that's the opportunity cost of using your money today, the interest rate that you would have earned on it by leaving it in the bank to use tomorrow. So the point of that example was to show you that interest rates influence what we choose to do with our money. If interest rates were to increase, then this would increase the opportunity cost of using our money. This would make us more inclined to save our money to use tomorrow or some other point in the future rather than spending it today. So the Reserve Bank uses monetary policy to influence these interest rates and therefore our choices. The RBA has a number of tools that it can use to do this, and probably the most well-known tool that is used in many other countries as well is a target for a very important interest rate called a policy interest rate. The policy interest rate influences many other interest rates in the economy. In Australia, this is the cash rate. More recently, the Reserve Bank has sought to target other interest rates as well, like the yield on 3-year Australian government bonds. By targeting these interest rates, the Reserve Bank changes the opportunity cost of money and thus influences the spending, saving, and borrowing decisions of economic agents. Economic agents are just different groupings of individuals in the economy, like households and businesses. The decisions of economic agents then influence the level of aggregate demand, employment, and inflation in the economy. This process is called the transmission of monetary policy. The Reserve Bank can then measure these outcomes and figure out whether it's meeting its objectives now and forecast whether it thinks it will meet its objectives in the future. It can then adjust monetary policy as is required. So before we finish, I'll give you a bit of a roadmap of what we're going to cover in this series of videos on monetary policy. This video was an introduction to monetary policy. Here we answered the first question that came from our definition, which is, why does monetary policy involve interest rates? Next, we'll look at the Reserve Bank's objectives, which apply to monetary policy as well as all of the other things that the RBA does. This will enable us to answer the question, what are the RBA's objectives? After that, we'll look at the toolkit that the Reserve Bank uses to set monetary policy and how this influences the different interest rates faced by economic agents. This will answer the question, how does the RBA influence interest rates? The next part of monetary policy we'll look at is called transmission, and this is a little complex. To deal with this, we're going to break it down into a few steps. The first part of transmission we already discussed. It relates to how the Reserve Bank uses its tools to influence interest rates in the economy. The next part involves looking at some channels by which monetary policy influences the spending, saving, and borrowing decisions of different economic agents. And the final part of transmission looks at how these channels affect economic activity, employment, and inflation. All of this enables us to answer the question, how do changes in interest rates impact the economy? This brings us to the final piece of the puzzle, the RBA's flexible inflation target. The flexible inflation target sets a measurable goal for the RBA to achieve with monetary policy. It links the outcome of monetary policy, which is the impact on economic activity, employment, and inflation, to the RBA's objectives. This allows us to answer the final question posed from our definition of monetary policy: how does the RBA measure whether it's meeting its objectives? So I'll leave it there for this video. Next in the series on monetary policy, we're going to look at the Reserve Bank's objectives. See you next time.